All right, welcome everybody. How are you today? My name is Derek Laughlin, president of Laughlin Wealth and retirementyoucancount.com. Welcome to the webinar today. Today we are going to talk about how to grow your money and protect it from market crashes and increasing taxes while creating a potential lifetime of tax-free cash flow. So hopefully that's what you're here today for. You signed up and this is what you're wanting to learn more about, is how to protect your money and grow it as a tax-free income cash flow. So we're just at the top of the hour here. I'm gonna give a few more minutes, let everybody kind of log in, make sure we got the everybody that's attempting to get in, so they can hear the whole thing, our whole webinar. It's gonna be about an hour. So if you don't mind, just before we start here, please chime in on the message box and let me know that you can hear me. I want to make sure we have good audio before we start, so I'll let that happen here. Just go ahead and type in yes is fine to let me know you can hear me okay. We're all loud and clear. So, all right. Okay. Well, I got one. Okay. 1, 2, 3. All right. So it looks 4, 5. All right. Good enough. All right. So I hear some yeses. So it sounds like we have good audio. All right. So let's go ahead and begin. Again, it'll be about an hour. So I'm trying to wrap this up. If we have time, we'll do some questions afterwards. If not, I don't want to go too longer than an hour. I know a lot of people are busy. I appreciate the time you're giving me today. So if we kind of go a little bit over an hour, just submit your questions. I will certainly get back to you within a 24-hour period and answer any questions you may have, okay? All right, so let's go ahead and go. All right, so all this is done without risking your money in the stock market or actively managing your money. Now, I want to warn you, this is kind of my initial warning here. The following information in this presentation will reveal information you've probably never seen before, okay? So don't be alarmed, but this is information you might not have seen before. Now, nothing's for sale. What I'm providing today is purely educational. So even if you wanted to buy something after this webinar, you simply cannot. Again, this is purely educational, purely just for your value. All right, the strategy is not for everybody. Nothing, of course, is. Everything, obviously, everybody has to be suitable for any kind of financial wealth building strategy. But I will tell you, this strategy is used by the ultra wealthy, bankers, and politicians. Banks such as U.S. Bank, Chase, Bank of America, Wells Fargo, Citibank, KeyBank, just to name a few. Of course, there's many, many more. All participate in these types of plans. If you look here, I blocked out here in the red. These are the billions of dollars these banks have invested in this asset class. 68% of research banks have more cash in this investment than they do invested in other hard assets like real estate. Here's just a continuing of the list of banks that utilize this asset class. Billions of dollars, again, are invested by each and all these banks here. Over $95 billion are invested in this asset. Anheuser-Busch, Pfizer, Johnson & Johnson, Verizon, Harley-Davidson are just some of the Fortune 500 companies that offer these types of plans for their executives, which are called executive benefit plans. Taft, McKinley, JFK, JCPenney's, Leland Stanford, creator of Central Pacific Railroad and Stanford University, Ray Kroc from McDonald's, original founder of McDonald's, and Walt Disney. Walt Disney actually had his plan in place for many years, and he actually financed the land that is Disneyland is on in Anaheim, California. So he used his plan to finance for the land that Disneyland is now currently on. And more recently, Jim Harbaugh, who is now the coach of Michigan. He left the Niners a couple years ago. Now he has signed, last year actually, he signed up a plan that his company, or Michigan, the University of Michigan, now helps fund a plan for him that will create millions of dollars of tax-free income for his retirement, therefore making him now the highest paid coach in collegiate football. And the wealthy use this on a massive level. 55% of this asset class is owned by the top 10% earners in America, and 22% of it is owned by the wealthiest 1% of Americans. So why is this asset class so enticing to the wealthy? Well, first of all, it's protection from crashes. Protection from crashes. When this asset is structured properly, it can protect your wealth. Growth. It can achieve potentially double-digit growth when the markets, of course, perform at that level. And tax protection. This is one of the best tax benefits left in the tax code, allowing unlimited contributions, which is perfect for high-income earners, tax-deferred growth, tax-free and penalty-free access to the funds throughout your life. And it does create cash flow for life. Again, when we properly structure these kind of plans, they can produce post-tax-free income for all of your life. So now it's just not the wealthy individuals who are the only people who can use these strategies. And the average American is simply just left out because they have no access to the plans. That's certainly not the case. It's just that most Americans don't have all the resources to invest and to learn about these little known assets that can be of huge benefit, but are simply never talked about with the financial advisors or the financial talk show individuals who we are so accustomed to seeing. But simply put, wouldn't you want to do what the wealthy actually do to safeguard against their money, against market losses and taxes? Now, this is not real estate, okay? It's not annuities, hedge funds, penny stocks, mutual funds, gold or silver, or any other type of exotic get-rich schemes that you can think of out there. Not saying that these are any up here. These are any get-rich-quick schemes up here. I'm just saying it's neither one of these asset classes. So I'm sure you've worked hard to save your money, and you simply just don't trust either Wall Street or the federal government's politicians in good faith of your savings. Now, so if this is you, if you have these concerns, then I want you to watch this presentation to the very end. Okay, it's important. I want you to go through this. Like I said, it's about an hour. We'll get through this, but it's important to stay till the end because in this presentation, you're going to discover how you can take the steps to protect your wealth from increasing taxes and profit during times of extreme market volatility. You can capture market returns without any risk of losses. Plus, you'll be able to leverage the assets in your plan for any type of critical illness or a long-term care event without even having to spend any additional money. Okay, and that's not everything. What you're able to do when these plans are correctly put in place is that you can pass on your wealth tax-free to your heirs as well. And of course, for sticking around to the end, I want to send you this hard copy of the book called Tax-Free Retirement. No strings attached, simply, at the end, put in your email or your mailing address in my contact page, and I will send you the book completely no cost. Great book by Patrick Kelly. He's been around for many, many years. He wrote the first book 10 years ago. This is a 10th year anniversary, so he's kind of recapturing what he talked about 10 years ago. National best-selling author. It's definitely a good read. All right, so the hard truth. Building wealth that delivers complete independence it is no easy task. If it was an easy task, we certainly would have all of us would be doing it. So even for high-income earning Americans, it can be very difficult to build wealth that is going to sustain you for all of your retirement years. Lobbyists and politicians make the rules, so they come out ahead and on top. Nowadays you couldn't name one politician out there who has left public office with less assets or money than they actually came in with. They're all millionaires, multimillionaires. Politics are the ruling class nowadays. They say what they need to say to get elected, what I call stay in the club. Once they're in the club, they do not want to leave, and they'll say whatever they have to. Most of them, what they do in office is to create greater wealth for themselves. Certainly, they're not there, so what they say is to serve the people. And as a result, many hardworking Americans have seen their financial outcome dramatically change. Pensions are either drastically reduced or pretty much eliminated. Right now, I would say in today's day and environment, pensions are a rare thing unless someone's been with a company for a long, long time and it was enacted when they first came to work for that company. 401ks barely tread water in good performing years. The only reason they truly do increase in value is because you continue to put money into them each and every week or every month that you're having earnings from a company. And when the next economic crash occurs, which because they always do, they're cyclical, the Americans' retirement accounts take a huge hit. So as you're listening to me, you're probably asking yourself, why should I even listen to you? What credibility do you have? And why are you explaining this to me? Well, this may not have happened to you, but let me explain the main reason why I'm here today talking to you. And maybe you can relate. Maybe you've had the same situation happen to you. So real quick, here's kind of a snapshot what led me to where I am now. So in 2000, right at 2000, my wife and I decided we need to start saving, put a plan together for retirement, right? Pretty common. Most people think about that when they get together, couples. It's obviously time to save. At some point in time, you need to start saving for retirement. Well, so my wife's job at the time consisted of marketing to many successful attorneys around in our area, in our city that we live in. And she was referred to supposedly this rock star financial advisor, this guy that had could do no wrong and had tons of money or assets under management, and he was the bee's knees. So before we met, we committed to $1,000 a month from the both of us, and we wanted to start with $10,000. I'd saved up some money, and I wanted to put $10,000 into a savings, and again $1,000 a month from the both of us. I thought it was a pretty solid investment. We're in our early 20s. I thought that was quite a bit of money actually, and well, it was a lot of money to us. So I was hoping he could do good with it. So before we met with this supposedly, like I said, rock star guy, he made it clear to us that he was doing us a favor, since our investing amount was rather low for him to manage. Okay, so basically setting the expectation that our money it's okay, but hey, listen, I don't do this for everybody. I just want to make sure. So basically, kind of setting the bar that hopefully he's going to be pretty good. That's what I would assume when I hear this before we even talk to the individual. So when we met with his advisor, he sits us down in his office with all of his wonderful company achievements awards on his desk. And I love this picture here because this is how I felt. I'm sorry I can't hear you over the sound of how awesome I am. Nothing worse, in my opinion, is when you need to hear about how great someone is, all their awards and how much money they've collected and how much, their assets they have under management. Just to me, it seems a little braggadocious, and I think normally I would want to know what can this person do for me. I'm not really worried about what he's done for everybody else. Well, that's the way his presentation started, kind of a build me up campaign. It was quite nauseating, but ultimately, all through it, I felt like, hey, okay, I guess this guy is good at what he does, and let's give him a shot. So it was not a good experience at all. He really belittled me through the informational process. The presentation really belittled me, questioned me on strategies and why I didn't know about them, and kind of was like almost shameful that I just didn't realize more about financial services or the financial industry, which I was there for him to tell me. I certainly didn't need to become educated prior to me coming into his presentation. So obviously that was really a negative time for me when I went and met with this individual, thinking we're going to give him money, and yet here he is treating me the way he was. But regardless or not, we went through it, gave him the assets or the money that we decided for, and let him see we could manage it and turn something positive. So, well, it didn't get any better. The timeline we started saving was in early 2000. So if you're on this and you understand, if you remember back then, of course, in the early 2000, we had three negative years in the markets. We had the dot-com crash, and September 11th kind of coincided after the dot-com crash, and it created 3 years of negative market returns. So very, very bad time to start investing, almost as if you were throwing your money away, because we didn't see any positive returns for quite some time. So what do most fund managers tell you? Just hang in the course, hang in there, stay the course. And truly, why they say that is because they get paid when your funds are in their investing platform. If you pull your money out and you put it into a money market account, well, there's no kind of value for them. They're not getting paid on those assets. So they want you to hang in there and, take the brunt and keep going. But sometimes that's just not what you're able to do. Sometimes you need to stop the bleeding and get out. Well, I was losing annually, back-to-back years, and still having to pay this guy $600 for an annual consultation fee. And in 2 years in, I couldn't take it anymore. I was basically throwing my money away. Every month, $1,000 was going in. I was continually losing every month. I mean, he did nothing to hedge or minimize our investment exposure against crappy market conditions. He simply had me in some basic form of investing or platform that his company had, nothing special, just mass-produced by the company he represented. So long story short, the advisor refused to accept that I wanted to liquidate and move on, and I had to reach out to the corporate side to liquidate my accounts. And as I was getting out of this advisor's program, he still felt the need to automatically deduct a $600 consulting fee from my account. And his reason for taking the money was I was supposed to meet with him, but I did not. And he still felt like I owed it to him in his mind. So again, I got my money back, the consultation fee, but we lost a lot of our hard-earned money with a supposedly this top-notch advisor, simply because, he never managed our money in the first place. Again, all it was is in some basic platform that the company gave. There was no managing of any assets. He didn't do anything. He didn't have any thought process. He just threw you into a basic platform, and there you on your way. So this whole process made me quite irritated as to see this, again, this successful guy. He had no thought or strategy what he was doing for us. So in a multi-market year decline when he wasn't even trying to protect our assets from market volatility. So why did I tell you this story? Well, it put me on a path where I'm at today. After a major shift in my career, about a year later than that experience, I decided to get my license in financial services. So again, my name is Derek Laughlin. I am a qualified safe money advisor. I've been nationally cited and been on various news outlets with some articles I've written. And I've been in the industry for now over a decade, and I help individuals build a foundation for retirement. When I came into this business, I was pretty jaded due to a horrible experience with a supposedly good advisor. So ultimately, and he did nothing special. When ultimately, those are the times that a client needs it the most, when we're in these negative market conditions. So ultimately, I went hunting for a solution. So individuals like myself didn't have to depend on complete market exposure, and take the emotional roller coaster out of saving for retirement. Now, and something that I was greatly interested in as well is, what are the ultra wealthy doing to create and grow their wealth, right? I mean, what are they doing? Because so many of them are never affected like the average American saver when market and economic conditions are negative. So, what are they doing different? You always hear the old saying, the rich get richer. I know it's cliche, right? We hear it, but the rich get richer. Well, why is that? Why are they getting richer? What are they doing that we're not, right? So here, what are they doing that we're not? Now, my discovery course, it didn't happen overnight. I put a lot of time in this. I put a lot of time. Once I became licensed, I researched many strategies. I worked with other successful advisors who I had established a good rapport with. I traveled throughout the United States, going to wealth and tax preservation seminars and learning about different wealth building strategies. Now, of course, not everything's for everybody, okay? But what I did discover was there was a certain type of asset class that was being used by a large majority of ultra wealthy investors. A large portion were using this type of asset class. And a lot of money was being put into these types of plans, and truly for good reason. As we talked about a few minutes ago, it provides safety, great growth potential, liquidity, and had tax advantages no other single strategy could truly offer. Now, something that you could truly rely on to protect our assets in volatile times. And it still gave you the opportunity to grow your money potentially double digits as well, of course, if the markets are performing at that level. All right. Now, before we dive into this, I know we're going to try to get to this. I know you want to hear what I want to talk about, but I really want to address today what we're currently at. What is our situation now and what we're facing in retirement? I think this is very important to understand where we currently are as American savers. So, let's face it. Today the blueprint for America is simply broken and outdated. Okay, just Google retirement stats 2017. After this webinar, I just go ahead, Google it. Same thing I put in there, and it's tons of bad reports. Tons. There's hardly anything good in the mix. Here's just a few. I know it's a lot of words here on the screen, but I mean, just look. 1 in 3 Americans have nothing saved for retirement. The average 50-year-old has $60,000 saved for retirement. Okay, so 50 years old and has got $60,000 saved for retirement. All right. 25% say they don't plan to work in retirement. So the other 75% already just have this idea that, hey, retirement's going to be working for us. Now, granted, I understand if you want to work, great, but do you have to work? I mean, it sounds like you're going to have to work in retirement. Another a big issue, of course, is student loan debt nowadays. It's getting bigger and bigger and bigger. All these financial institutions or the government, loans out these huge amounts of money for these kids to go to school and get these degrees that really don't yield any kind of good cash flow. So that's going to be a big problem later, even going forward. The average Social Security check is $13.55 per month, and then almost 47% of single seniors rely strictly on that Social Security money as their retirement income, and then 22% of married couples rely on it as their sole income for retirement. And this is it's another issue I like to really focus on. Is a retired couple can expect to spend over $250,000 in retirement just on health care alone, which majority of individuals are leaving this health care completely out of the picture and are certainly not prepared what can come down the pipeline. So why doing with the status quo? Why does it put us in such bad shape when we plan for retirement? Well, first of all, our go-to investment is an account that has primarily no protection for volatility. It's a direct risk to the market, okay? And in the end, when it's time to use those funds, you're taxed on the whole amount. My thoughts on creating a successful retirement is pretty simple, in my opinion. I may have a different look on it than the majority of people, but utilizing strategies that will yield us the amount of income we need on an annual basis to sustain a lifestyle we want. All right? So we need to be focused on cash flow and focus on investment strategies that will yield us the most cash flow. It's all about cash flow. How much cash flow are we going to need on an annual basis and going forward to sustain our lifestyle in retirement, right? And a lot of individuals don't even know how much truly cash they're going to need or how much they want to have a good, fruitful retirement. So in my opinion, cash flow is king. Wall Street will have you believe the idea that you should be focused on some big nest egg number. Just save, save, save this big nest egg. That's more likely subject to risk as you save. And then implement what they call a 4% rule. Okay, the 4% rule says an individual should be able to take out 4% of your nest egg in income and have it last the rest of your life. Well, unfortunately, there's quite a few problems with that 4% rule. There's just a few articles you can. Again, you could research it yourself, but you could look. There's all over the place. Don't rely on the 4% rule for retirement. Market Watch, and that's in 2016. Motley Fool, 3 serious problems with the 4% rule. It go on and on and on. The 4% rule could spell trouble for you and early retirees. So obviously, there is a problem with the 4% rule. It's not necessarily as a foolproof, and it's not something that you should truly rely on as a retirement income strategy. So the reason the 4% rule doesn't work is because it's something called, we say, the sequence of returns, okay? Now, your nest egg and retirement income can vary greatly depending on whether the market goes up or it goes down in the first phase of your retirement, which I say the first phase, the first 5-7 years or so of retirement, the market's behavior can dramatically change the outcome of your retirement. So the sequence of returns, again, if you started with withdrawals in an up market, when you had high early returns, your money could possibly last you up to 37 years. Great. Awesome. Hey, but again, that's if you are retiring in a favorable market environment. Now, if you started withdrawals in a down market, which means obviously low early returns or negative, even worse, your money would only last you 24 years. That's a difference of 13 years, just depending on what the markets do in a period of the first 5 to 7 years. Now, it's a long time. 5 to 7 years, there's a lot can happen. A lot can happen in that period of time. So that definitely will dictate how much cash flow are you going to be able to rely on your retirement accounts to yield you if you have to worry about these fluctuating market conditions in the first phase of your retirement. Now, it's not just having a big nest egg or a big net worth. The truth is, more and more people are now realizing that a big nest egg doesn't do you a dang bit of good if you lose half of it anytime the market crashes, or you have to pay tons of taxes on it when you access it. All right, but let's get back to the 4% rule, okay? Because this is I want to put this in context right here. What the 4% rule means as a cash flow. So let's say you saved $1 million for retirement. Maybe as you're watching this webinar, you're thinking $1 million. Oh, that's a lot of money. Well, I'm just using it for simplicity, for obviously for numbers here. Yeah, it is a lot of money, right? But let's just say you saved up that $1 million for retirement. So, well, if you're going to abide by the 4% rule, well, that's $40,000 per year. You're going to be able to take out of your nest egg and hopefully have it last your lifetime. Well, more than likely, taxes will need to be paid on this because it's probably in a 401k or an IRA of some sort. So let's say you pay 15% federal, maybe you're in a state that's 6% state. So maybe you don't live in a state with income tax, but for this obviously example, we're going to use both. So after taxes, that's a whopping $31,000 or $31,600, okay? And that's about $2,600 per month. That's following the 4% rule. So for having $1 million saved up, and all I can withdraw is $2,600 after taxes, to me, that's certainly not all that impressive. That I've had $1 million saved up, and that's all I'm going to be able to withdraw so I can sustain this cash or this nest egg for the duration of my retirement. So what if that $1 million takes a 30% hit during a market crash during your retirement, and you still have it vested in some sort, and the market tanks, you lose a 30%. Now you're down to $700,000. All right. Now your monthly income is down to $1,843. That is now. If I didn't think the $2,000 was that impressive, $1,843 certainly isn't that impressive as well for having that kind of cash in my account, and it's subject to risk. So now I think it's safe to say that the majority of American savers understand that booms and busts are a fact in our current financial markets. During volatile times and big swings in the market, our wealth is at great risk. But this is a time when we need preservation the most. So what happens when these booms and busts cycles start to become much more frequent because the world and our own country seems to be more volatile than ever? Our retirements take a huge hit. Just take a look at our current events all around us. Just in 2017, market did great. Obviously had this crazy rise. There was no volatility, but then 2018 comes around, and now we have all these fluctuations. And now Trump has been here a little over a year now. But just the election of Trump. You can love him or you hate him, but just having him as a president right now is a polarizing effect. I mean, I've never seen so much division in our country about having him as our current president. Kim Jong Un, that's to be determined. Supposedly there's a peace deal right now, but still, times before that, there's a lot of uncertainty with what his regime's doing, the nukes and whatnot. ISIS, another question mark. How long are they going to continue to sustain their influence, their terrorist influence all around the country or the world? And then here's a little geopolitical, I guess you say, hot map. BlackRock is the world's largest investment manager. They put this out last year, 2017, and it shows all the major tension or geopolitical risks we have in the world. All right, and you can see all these still, even though this is 17, South China Sea conflict, that's still something. North Korea, escalation, Syria, Iraq, U.S.-China tensions, North American trade tensions. All these are still current. These haven't gone away. And if you notice, America is in just about every single geopolitical risk around the globe. And so when we have these geopolitical risks, what happens is our economies are at risk as well. And what happens, of course, the markets go up and down. The markets fluctuate drastically based on these geopolitical issues that we have, which really could pop at any time. So we're at the mercy of these situations going haywire. And what happens is, our retirement accounts could take a massive hit, or they do. And these huge swings we've had just in 2018, 1,000-point swings we've had. So it is an issue. And our own government, of course, the real estate, .coms, dollars, student loans. These are all issues we have that are currently kind of looming right now. Every major economic shock in recent decades has been preceded by an asset bubble. This here is Richard Sharma. He's head of emerging markets at Morgan Stanley. And then what he comes to say is that his team's composite valuation for the three major financial assets in America, stocks, bonds, and houses, it's currently well above levels reached during the bubbles of the 2000 and 2007. So the question again is, do you want to build your wealth and retirement with a strategy that you ultimately have no control over? So with that in mind, have you ever done the math on the potential impact of money lost from your account in a given market crash? Have you ever done that? Have you seen how much money you've lost in a particular time and calculated that out and say, hey, you know what, if I never lost that money, how much would that be worth in today's time or 10 years later? So I want you to look at this and tell me this is pretty captivating here. Show you. Let's say age 45, okay, individual has $50,000 in his account. Well, he lost $50,000. I'm sorry. He lost $50,000 in his 401k IRA, whatever it is, subject to market loss. Again, he was 45 when he lost the money. Let's fast forward that to age 65, okay? So he's going to plan retirement age of 65. What would the value be of this $50,000 if he never lost it in his account in the first place? What is the earning potential? Well, in the first 20 years, he was 45 when he lost it. Now we're fast forwarding to age 65 at a 7% growth rate, which is nothing crazy. That's not some high rate of return. The true capital loss is $193,000 of cash flow or of cash value that $50,000 was worth. It could be worth in today or 20 years later. So if this individual never lost the $50,000 20 years prior, his account could be roughly $200,000 more in value. Okay. So now when we obviously are starting retirement at age 65, it's certainly not the end, it's a starting. So let's fast forward another 20 years and show the value of that $50,000 at work again, continuing at a 7% rate of return, nothing good, nothing crazy. Now we have 40 years of earnings of that time that money could have compiled, and we could have had compounding interest on that. That would be worth $750,000. Now, nobody I've ever met has said $750,000 isn't a lot of money. That can affect just about everybody's retirement platform, period. And that's if we never lost the money 40 years prior. So I guarantee everybody on this phone or on this webinar today has lost some money in the market. Again, check it out. See how much money you could have if you never lost that money in the first place, right? Because once the money's gone, it's gone. Yes, you rebuild the account in the years to come, but that's new money coming into the account. That doesn't take back the fact that you lost that money in '08. You don't get that money back. That's gone forever. You just rebuilt it. Took you 5 years probably to get back to ground zero again, but that's new money coming into your account. So again, look at the value, this $50,000 over a 40-year period of time. It's $750,000 just by able to preserve it. Look how much more we would have had. All right, so as you can see, losing money out of your retirement account due to a market correction is huge, huge. All right, in fact, as history shows, the markets will lose approximately half of its value every 10 to 12 years. Now, is this again, is this a strategy that you can depend on, or do you want to depend on this kind of strategy? But unfortunately, in today's environment, there's really no other option for real growth on your money unless you're somehow tied to the market. Somehow your money has to be tied to the markets to have some optimal growth. The days of having high fixed interest rates, rates of returns, is simply in the past, and I'm not sure it's coming back anytime soon. The fixed rates back in the early '80s, nah, I don't see that coming. We've been pretty flat for many, many years, and I think so with the amount of debt we have and that we've compiled, I certainly don't see interest rates creeping back up to those double-digit numbers. We would owe a tremendous amount of interest in all the debt we have. So, how do the wealthy seem to come out unscathed, no matter what the economic conditions are? Well, the wealthy have a strategy to deal with volatility and to profit from it. So instead of seeing a market, the ups and downs or the ebbs and flow of the market, we would see something like this, where we have the downward trend of a market, they would stay flat. They would hedge against any losses. Then, of course, when we have the return of the uptick of a market again after a crash, they're going to be able to capitalize on those gains again and again flat. So they're basically hedging against losses in the market and capitalizing on the upside. That's what the wealthy are doing with their cash flow or with their assets. They're not subject to market loss. So, but the past volatility of the market in the last 30 years has been really bad for the average investor, okay? The average investor has really just taken it bad. The 20-year annualized return comes in at just 2.5%, while the 30-year annualized rate is just 1.9. Now, this came from, this was published in Forbes, comes from Dalbar. Dalbar is the leading institution for compiling investor behavior, rates of return. They do a great job. It's very factual. They are, by far, if you ever want to look at any kind of stats on what returns are over a period of time, Dalbar is definitely the company to look at. And then here's just another chart showing you that the S&P does pretty well, right? The S&P did pretty well here. We look at the years of returns, the last, anywhere from the 30 to 5, right? It didn't do terrible at all. But look what equity, the investor returns are. Much, much lower than what the actual S&P is doing. The actual market's doing is certainly not what the investor, the average investor is actually getting as a return. If you look here, this is half of they're getting 30-year, 10.35, 3.66, 20-year, 4.67. These are equity funds, managed assets. So why is the average investor getting such a poor performance? Well, it's because it's fear and emotion, right? And of course, we all know that. We're all scared of the next market downturn. What happens is so you sell on the way down. At some point, you can't take it anymore. Just like myself, when I was in there, I couldn't take it anymore. I just kept putting money in, but at some point, I couldn't take the losses anymore. I had to get the heck out of there. It's all, of course, it's easy to say, just hang in there, hang in there. Well, no, most people do get out. They get out at some point. And then what happens is they're so gun shy about getting back in and missing this, what we call a bounce back, which I'll explain in a few minutes, but they get this bounce back after the market drops. They get in at a higher level and they miss all those returns. They could at least gotten, captured some of the gains back from the losses. And so you have this revolving cycle of getting out too late and getting back in too late. And you just continue to lose and you don't get the true, the ups when you should have, hopefully you got them from the bottom all the way to the top. You would have gotten all those gains. And here's just an investor psychology cycle showing how, the excitement, the thrill, euphoria, wow, you did a great job. Your money's just growing. Then here we go, a market crash, desperation, panic, capitulation, despondency. Then, of course, desperation. So it's just this over and over cycle of just ups and downs of the market. So what about having, like I said a minute ago, we talked about this, someone having and actively manage your money? Would the results be better? You think they'd be better, right? If someone actively managing your money. I didn't have a good outcome with it, but maybe some other individuals did. I don't know, or as an industry. Well, I wouldn't say that. A staggering 86% of active large cap fund managers failed to beat their benchmarks last year. This is actually in 2014. And the S&P indexes score released on Thursday. This year, again, 86% stunk in 14. And then, of course, here over the past 5 years, 82% did the same over the last decade. Okay, so basically, fund managers aren't even beating out the S&P to have your money actively managed. All right, so here's another slide I had. I like this article as well. This is a few target date fund managers eat their own cooking. Okay, that's what it was titled. 57 target date mutual funds analyzed by Morningstar. 32 of the 57 have zero personal investment from their fund managers. Over half of these target date mutual funds analyzed, they don't have a dime invested from their own fund manager in there. Wow, that's pretty startling, isn't it? That means show them how much faith they have in their own fund. That 32 of the 57 have zero personal investment in their actual fund. Unbelievable, right? Well, and here's another one just to kind of close this out that shows how many fund managers actually even beat the index, right? 1 in 20 actively managed domestic funds actually beat the S&P 500. Okay, over the last 15 years, 92% of large cap funds obviously didn't beat the S&P, 95 of mid cap, and 93 of small cap. So very, very, very few actually beat the performance of the S&P 500. 90+% lagged behind the S&P 500. Okay, so it looks as if you could have had saved the 2%, whatever your management fee is, and had a dog pick some of the mutual funds or stocks for you based on the past performance of most fund managers over the last 15 or so years. But the status quo and the financial talking heads say to invest your assets just the way we discussed. And when the market crashes, so does your retirement account. You know, just look at this as the last two losses we had, early 2000, of course, in 08 and 09, right? It took 6 years to recover from the losses in early 2000. And it took 5 years to recover from our losses in 08, okay? So in just the past 17 years, from 2000 now to 17, or from full time of 17, took you 11 years of potential gains just to make up for the losses in the market. 11 years of the 17. 11 of those years were having to make up for the losses you had in the market. Crazy. John Bogle, okay, he is the founder of Vanguard. He was quoted saying, "Our financial system, essentially our money managers, marketers of investment products, and stockbrokers put up 0% of the capital and assume 0% of the risk, yet receive fully 80% of the return. Something's kind of gone wrong with our financial system." Okay? So if the stock market is where we have to grow our money, okay, but volatility keeps us from really gaining wealth, what are the wealthy doing to obviously do, or they're doing something different, right? They're obviously in some link to the market for performance, but they're doing something different to hedge against those losses, all right? A book was written, The Millionaire Next Door, was written by Thomas Stanley, did extensive research on the behaviors of millionaires, was quoted saying this in his book: "The affluent typically have less than 30% of their money invested in stocks, usually actually less than 20%. They have it in other asset classes they control," okay? That's pretty telling. Again, I showed this graph to you early on the when we very first started. The top 10% earners in America own over half the assets in this plan. Okay, 22% of this investment asset class is owned by the wealthiest 1%. So this is what the affluent are actually doing, not what the financial analysts are advising or what money managers are telling you to do. And what we call this is it's indexing, okay? This is what they're actually doing. This is what the wealthy are doing. And this is one of the asset classes that the wealthy use to protect their money from volatile market conditions, all right? The strategy allows you to profit from market volatility and capture the market gains as the markets rise. And when the stock markets come crashing down, your assets are always protected, okay? So you're hedging against those negative years the market can just drain your account. You never lose your money, and when you put it into your plan or the interest earned, you simply never lose any principal or interest you put into your plan. And I'm sure you've seen this and you notice this trend. So when the market crashes in any given year, it's followed by multiple years of double-digit returns called the bounce back. And we were talking about it a few moments ago, where the market plummets. When your investor behavior, you get out and you miss all those returns because you're gun shy about getting back in. But that's when the big returns happen, is when the market bottoms out and you get those big bounce backs. That's when you get those huge returns, which you can capitalize on. So this becomes a buying opportunity for individuals to get to the stocks at a reduced value, feeding the return of a positive market performance. But that's if you even have the funds to get in the market. Okay, majority of people have lost a lot of their assets, and they're like, again, they're gun shy about getting back in. So instead of trying to time the market, which is truly impossible, or analyze what all the financial gurus are saying, what's going to happen next, you just implement a strategy of avoiding any type of market loss, 20, 30, 40%, and get the bounce back returns that could be potentially double digits following that given year of a market crash. So instead of having a market that looks something like this, the downs, the ups and downs, we're capitalizing on the ups. We're staying stagnant on the downs. We don't get this. We get the X, put the X's there where the downs are. We stay stagnant. We continue to have a positive impact when the markets go up. The strategy would certainly minimize the impact of losing your hard-earned savings from crashes and let you profit from market volatile conditions. And when the strategy is presented to individuals, they always have the first thought to say, nah, you know what, this is too good to be true. Don't even think it can be possible to accomplish without being a very savvy investor and having to spend probably a lot of money to achieve these results. But it can be accomplished, okay? And that's what I call the cash maximized IUL, using the indexing strategy, or a cash maximized indexed universal life. Now, the strategy is offered primarily through insurance companies. That's only companies who offer this are insurance companies. The strategy is linked to the index, but unlike a traditional market investments, your assets are not directly in the market. This allows you to capture the upside movements of the market yields, and more importantly, then again, like I said, it protects your assets when the market crashes. Investing in indices has been widely used by the most respected investors of our time. The indexes simply provide the most consistent and predictable returns over a long period of time. And the main one we use is the S&P 500, okay? So why do we use the S&P 500 as the main index for our accumulation? Well, because it's a strong representation of the compilation of the strongest companies in America. The 500 largest, not say largest, but well-known companies, well-ran companies are compiled into one index of 500. Then they call it the S&P 500. And it always beats actively managed funds, at least for quite a few years now it has. I show this repeated, this same slide here over the last 15 years. Again, 92% of large cap, mid cap, small cap, all in the 90s have lagged behind the S&P. The S&P has outperformed all these managed funds. So it's definitely done very, very well for investors. John Bogle, again, the owner of Vanguard. Use the index fund. Of course, it's boring. Just capture the market return year after year. Charles Schwab, most people should really go into index funds. They have the most predictable outcomes. Warren Buffett, indexing is the way to go. Invest in great American businesses without paying all the fees of a mutual fund manager. So with a strategy of indexing with a cash accumulation IUL, you will capture an unlimited upside gains and lock in those gains year after year while eliminating all potential losses for any given year, because you have that floor of zero, okay? Your floor is zero. You don't have to worry about negatives. Now, I must tell you in advance, not all companies are offering unlimited upside potential. There are some caps or participation limits on the interest earning potential of these indexes, okay? Now, these caps can be anywhere from 11 to 17%, depending on, what company you decide to work with. So you have to watch, some of these companies don't offer the greatest caps or the greatest participation limits, which means they'll let you participate in 90 or 80% of the market return. So you would get, if they give you 90%, if the market did 10%, you're going to get 9%. That's where that participation comes into play, okay? So not all companies are created equal, and this could really limit the potential cash flow in your retirement. So since we've been doing this for a long time, we know exactly what companies to use and partner with to provide our clients the absolute largest cash flow possible. That's the name of the game. When you put these plans together, it's about creating the largest amount of cash flow we can for the individual for retirement funding, okay? Our custom-made plans will provide uncapped index limits and provide an unlimited upside potential in your cash value growth. It's important to work with companies that offer this. Again, not all companies are equal, and basically some products are certainly better than others. So it's very important you work with a strong insurance company, like I just stressed a moment ago, with this asset class that provides the best performing indexes and a history of offering high cap or even uncapped limits for maximum growth potential. All right. So let's look at the past performance of this strategy. Let's see how this is looked compared to the actual S&P, the ups and downs of the market. Okay, so the next slide is going to show you the last 17 years and the impact on the cash value. So this is our cash maximized indexed UL plan. The actual S&P performance is in the red. You notice here we have the market losses, the last couple big years, the 2 dips, and then of course the market's been on a steady incline. But what's different about this again is the protection from the losses. The years we have losses, we stay stagnant. Okay, we didn't grow anything here. Okay, but we didn't lose. And when the market ticks back up, we're going to get a portion of those returns. But we're going to have a larger amount of assets in our plan because we didn't lose 20 or 30% of the value. We didn't lose. So if the market goes up, we're getting a larger increase because we have more money in our cash value. As you can see, here's a steady growth. And I mean, it's pretty self-explanatory. Which line would you take, the green or the red? I mean, who wouldn't take the green, right? We're talking about, $260,000 difference. I mean, it's pretty much a no-brainer on what strategy is obviously the winner here. The actual S&P and our market performance, or using the S&P but minimizing the losses. We're still using the S&P for returns because it provides great returns, but we're minimizing the losses. So look at the performance. I mean, it's amazing. It's huge. And here's what this actual index did. It's called the S&P Low Volatility Index. It's 100% participation with a 0% floor. So you have 0% of loss, right? That's our protection. And you're participating 100% in this low volatility index. Now, this is not the actual S&P. This is using a combination of the least 100 volatile stocks inside the S&P. So it's taking 100 of the 500 stocks, okay? The least volatile companies, compiling those together, and you're getting the performance of those companies combined, okay? This is what it's done over the 10, 15, 20, you see so odd years. We're averaging 10%, 10, 20 or 8%, but these are some solid returns. These are looking good. Having these returns with no loss, that's where you've seen the huge difference of the 555 to 295. Having that, you can depend on a 10% rate of return with not having any kind of negative impact, can do tremendous value for your cash value growth. All right, so we like to stress test this. I love using this slide as well to show you how this strategy would have performed in the worst 10 years in history since inception of the S&P. Okay, a couple hundred years since it's been since its inception. This is the worst decade in the S&P 500 history. They call it the lost decade, which has occurred here since in 2000 to 2010. We incurred those 2 major losses. The actual return was -1% in that only that 10-year period. In a strategy like we're using the index, it actually would have done 6.21. So in the worst decade in history, we would have done a 6.21%. Besides, if you were just in the market, losing a 1% over a 10-year period. Again, kind of a no-brainer which strategy I would use. Okay, so you can see how powerful this strategy can be when you avoid market crashes and capitalize on the years of the bounce back. How would you feel if you had invested in the worst 10-year period in market history and not made a dime the conventional way of investing, actually losing, okay? But actually you made 6.21% rate of return using the indexing strategy with a cash maximized IUL. Obviously, I'd feel quite a bit different if I'd done that in the worst 10-year history. Well, and just having the ultimate peace of mind knowing that when markets crash, because they will eventually, again, the market is cyclical, we go up, it will come down, that it's not a time of worry and pacing around wondering how much damage will be done. It's actually the beginning of a potential bounce back period that could yield you double-digit returns in the years following a market crash, okay? Again, all without losing a dime, all right? Ultimately, no more emotional roller coaster, just steady growth, positively affecting your retirement outlook, all right? Now, I want to switch gears here a little bit. We're about halfway through. I want to go through and talk about another huge issue facing retirees. It's the first half of this presentation was about reducing market volatility when it comes to investing. Now, just as important as diversifying the risk of loss in your retirement savings is you need to diversify the potential tax burden in retirement. Taxes. Those who save the most will certainly be Uncle Sam's best customers, right? Not planning for taxes in retirement is a huge mistake. There is no reason to give more than is needed to the IRS simply because you have no plan was put in place, okay? Ed Slott, national tax expert and CPA, New York Times bestselling author, taxes will be your single biggest retirement risk. He's quoted many times saying that. He's an advocate of doing proper tax planning. Taxes are a big issue when we talk about it in retirement that unfortunately the majority have done nothing about. Maybe you're thinking I'll be in a lower tax bracket when I retire, right? That's all wishful thinking. But really, have you ever really thought about that idea? I mean, are you really going to be in a lower tax bracket? Do you want to cut back on your lifestyle than what you're currently doing when you enter retirement? Are you not going to have any debt? Is your house going to be paid off? Are all these things going to be taken care of? Unless you want to chop your income in half and somehow reduce your expenses to 50% or more, you're more than likely going to need close to the same amount of income as you needed prior to retirement. I mean, let's look at a quick example how the tax impact on retirement income can be. So for this example, an individual put away $6,000 a year in a 401k IRA, a taxable account. They did it for a total of 35 years. So we had put in $210,000 of contributions. $6,000 times 35 years, 210. Let's say their combined tax bracket is 30%. So their annual taxes deferred is $1,800. Okay, so 30% of the $6,000, that's the taxes. They're deferring $1,800 each time they deposit into this account. So over 35 years, they have saved $63,000 in potential tax burden. That's the taxation they saved at this tax bracket. Okay, all right. So hopefully now it's time to reap the benefits, right? Well, not so fast, because let's break this down and check it out, what the impact of taxes are. So annual income for retirement, taking $75,000 out, you've amassed $1 million in your account. You are taking out $75,000 a year. Let's just say, for simplicity, your 30% tax bracket, we're still the same. That's $19,000 that's coming out of that account. Your net income is $56,000. And so that was $56,000 your net income. So if we take that 20 years of $19,000, that's $380,000 in taxes. $380,000 in taxes we're going to pay on that money when we could have. We only SAC savings was 63. That's it. But now we're going to pay $380,000 in taxes. And here's just a quick breakdown to show you where our progressive tax system, how we tax this money. Again, here's our total of $19,000. So would you have rather paid the $63,000 in taxes at the very beginning and just gotten it out of the way and paid it and let your money grow in a tax-free bucket? Or are you good with paying $380,000 in taxes? Is this really a good deal? Is this really a good deal to have all your money sitting in a qualified taxable account when you retire? Because I'll tell you what, the government, the IRS, loves these plans. They love your 401k and they love your IRA. So the last slide was about our current tax rates. The tax burden certainly could be greater when you use it for your retirement savings one day, or your retirement. The reason I say this is let's take a look at what lies ahead based on what our government has done up till now. David Walker was a former Comptroller General of the United States, head of Government Accountability Office. So basically, he's in charge of ensuring federal spending is fiscally responsible. He was during the Bush administration and some of the Obama administration. He is quoted saying, based on our current fiscal path, future tax rates will have to double or our country will simply go bankrupt. Again, in this latter part of his article, he talks about here of the 18.5 at the time, our 18.5 trillion unfunded civilian, or 18.5 trillion unfunded liabilities is not the true number. The real number is about 65 trillion over 18 because we have Social Security, Medicare, the government, the federal government entities, pensions that we have to pay for. That's not included in this money or the number we always see publicly shown, which is about right now 20 trillion. The number is about triple, or at least, it's about triple. It's about triple that. Huge amounts. So the problem we see in Medicare and Social Security are pretty easy to see. We all have seen this just continue to snowball. Each administration seems to kick it down the road. They're not taking care of this and trying to figure out the issues. When Social Security was passed and approved in 1935, the average individual citizen in America had an average lifespan of 62, and they began retirement at 65. So when Social Security was implemented or put in play, in 35, they were pretty comfortable about, not running out of cash flow for retirees. But today the times have changed. In 35, 42 were paying into one receiving. Now we have 3 paying into 1 receiving. And now the average lifespan of Americans is 84 years old with the enhancements of medical care, of course, and prescription medicines. And now, as we showed way earlier in our presentation, is that Social Security income has come mainly the main source of income for most people's retirements. Okay? This just shows Medicare spending. It's certainly not going down. It's continuing to increase each and every year as more people get put or get enrolled into the Medicare program. It continues just to continue to escalate, spending more money. More tax dollars are having to be allocated towards this. So, of course, our tax deficit just keeps climbing and climbing and climbing. The impact of the baby boom generation retiring is certainly putting pressure on Social Security and the Medicare systems. 10,000 baby boomers are retiring each and every day for the next 16 or so years, 17 years. A total of 78 million baby boomers are retiring, and it just continues to climb and climb. And those numbers are going to continue to get bigger and bigger and bigger. So what can be done to fix this problem? Well, there's truly two quick answers that we can do. We can continue to either borrow more money if other government entities are going to continue to, or foreign government entities are going to continue to loan us money, with us the promise of us paying them back. We're going to continue just to pile on the debt and keep going if that's even sustainable. I guess time will tell if it is. Or we can simply raise taxes. The top tax rate in the 60s was 91%. I know we're in a relatively low tax environment now, but they have been that high. So who's to say taxes will not creep up again? It certainly can happen. It happened then. Why couldn't it happen in the future? We certainly don't know. And if push comes to shove, I see the government raising taxes more or less than just drastically reduce spending. How would you feel about a 94% tax rate? Roosevelt never got 100. He wanted 100%. However, the Revenue Act of 1942 raised rates to 88% on incomes over 200,000. By 1944, the bottom rate had more than doubled to 23, and the top rate reached an all-time high of 94%. The Congressional Budget Office, this was done a couple years ago, but they are the true analysis of our fiscal responsibility. It's a bipartisan program. What they say is not a if the Democrat or Republicans in office, they try to side with whichever administration's there. It's a pretty, again, bipartisan consensus of where we're at. If Social Security and Medicare and Medicaid go unchanged, the lowest tax bracket would increase from 10 to 25%. Well, Social Security, Medicare, and Medicaid have gone unchanged. They have not done anything with it. So at some point in time, we very well could see these increases, 10 to 25% for the lowest bracket. The 25% bracket would increase to 63%, 2.5 times. And the highest bracket would go from 39 to 88%. Again, Congressional Budget Office is quoted saying these rates here, these possibly could be where we're headed. So there is a reason Ed Slott is, the national best-selling author, is saying taxes will be your single biggest retirement risk. An increase like the CBO has mentioned could mean an additional 30 to 40% reduction in your retirement income after taxes. Oh my God, that's huge. Could you imagine having 30 to 40% less than you're already going to be getting on top of the taxation you're incurring now? So if you don't enjoy paying taxes now, how would you feel when you're not working anymore? And again, at a minimum, 25% or more is going to go to our Uncle Sam. So as I talk to individuals all throughout the U.S., I find that 90% have done nothing about taxes. Nothing. All right, the burden it's going to place on your retirement, and it is a huge burden. I mean, most people have this scenario in retirement. They have all their money in taxable accounts, 401ks, IRAs, their pensions, Social Security. All that is taxable income. All right, and majority of retirement portfolios are looking like this: 100% over here, 0% in a tax-free allocation. No tax-free income to offset this massive tax of time bomb they're going to have over here. So I do understand having some of your assets in qualified accounts, your 401k, your IRA, your 403b, whatever your company might be offering you as part of your employment package, right? And hopefully you're getting some sort of income match to help entice you putting money into that plan. But having all your assets in taxable accounts is simply not advantageous to anybody but the IRS. Again, it's just as important to be market diversified as to be tax diversified as well. Yet, and I have not found anybody who enjoys paying taxes or paying taxes. So today in 2018, currently we have witnessed the first major tax reform in recent history. And yes, this is certainly helpful for most of all Americans, right? Any tax break, of course, tax reduction is beneficial. But the federal government continues to spend money at historically high rates. And most agree that an economy stimulated just with tax reform will not offset the massive deficit spending the government still is incurring, continuing to spend massive amounts of money, much more than we're taking in. Goldman Sachs, he's red ink everywhere, warns U.S. spending could push up rates and debt levels. The U.S. economy will not be able to count on the pump priming for tax cuts very long. So this is just one quick article I found, but we're still spending a massive amount of money. The tax reduction, it will be short-lived. It will be short-lived. And this is just a continuing of the article. Federal deficit spending is headed towards an uncharted territory, the firm said on Sunday, suggesting that the Trump administration and congressional Republicans may not be able to count on the economic boost of tax reform for very, very much longer. All right, so in short, I say take advantage of these next 8 years. This was not a bipartisan bill, so it's not permanent. So the tax cuts are temporary. So for the next 8 years, these will be in force. So take advantage of those times, okay, of the lower tiers. But what happens after that is anybody's guess, all right? And now is a great time to convert your assets from taxable to tax-free than any other time in recent history. We're at a more favorable environment now than we've seen in a long, long time. So this is how the wealthy are thinking. They're creating methods to have the majority of their income in a 0% tax bracket. They're utilizing times like now in their business and their personal to convert their assets to even more tax favorable environment. So why not create the most favorable income environment like the wealthy do for themselves? And again, this easily can be done and accomplished by you. No matter what your net worth is, you can create this kind of plan to work for your situation. When structuring a cash maximized IUL, it gives you a tax-deferred growth on the cash value and tax-free income. There are no age limits or income limits, and you can put unlimited amounts of money into the plan. No contribution limits whatsoever, okay? So just to recap again, we went through a lot of material here. You can achieve potentially double-digit returns if the market's performing at that level, of course, with no market loss. You have tax-deferred growth on your assets. You have tax-free income distribution, okay, when you decide to use it. If it is retirement, maybe it's a little bit earlier, but you have tax-free income distribution, okay, and a tax-free death benefit, or it's a wealth transfer that goes to your heirs. So let's talk a little bit about the tax-free distributions and the income stream this strategy is going to provide. With the cash maximized IUL, it has a very unique feature that traditional investments simply just do not have, and it's called a participating loan agreement. Participating loan agreement. This feature allows you to take money out of your cash maximized IUL for annual cash flow that can capture index gains on that very same cash flow that you're using. Now, I know that sounds crazy, but you are able to take the money out of your plan and basically loaning it to yourself and still have access to have gains attribute to those monies. The strategy we can use inside the plan is called income arbitrage. Banks are great at doing this and can utilize this with properly structured cash maximized IULs plans. This process allows you to capture index returns on the principal even long after you use the money in your annual cash flow. So here's a quick example of how this works. Say you need $100,000 of annual cash flow out of your plan, and that current year the index did 10%, okay, for that calendar year. Your account would be credited for $10,000 in interest on that $100,000, even though you'd use the money for your annual cash flow, okay? And this cycle will continue each and every year as if your principal had never been touched, and you continue to earn interest credit for the index you're participating in. When using this method for cash flow, you can then charge a guaranteed interest rate loan rate, which sets up for an income that is non-tax. That's why the income is non-tax. The IRS does not tax loaned income, so there is no reporting of income needed. Utilizing this strategy, this allows for you to take advantage of the best tax savings code in the IRS. More specifically, it's called the IRS Code 7702. This section code 7702 allows for the tax exemption of life insurance companies. When you're creating this arbitrage effect on your cash flow, this allows you to create a much higher amount of income than you would create on any kind of traditional retirement account. Let's just look at an example here. Now, there's a lot of numbers here, but I want to show a plan side by side. A traditional 401k or IRA here on the right, and a retirement you can count on, or I call these cash maximized IUL plan, a properly structured plan creating cash flow. So in this instance, we have a 45-year-old investing for 20 years up to age 65, again, 45 to age 65, $20,000 of after-tax dollars going in. This is a pre-tax, so this has not been taxed yet, $24,000 going into this plan, okay? So at the age of retirement, we want to start distributions. We start taking our distributions, and I got a little ahead of myself here. Our estimated growth is 7%. 7% for both accounts, okay? So here we start taking out our distributions, $77,000 of tax-free income. Okay, we've amassed $836,000 of cash value. Now we're taking out our tax-free distribution. And that is $77,000 for life. Actually goes under 100. This screen just shut off here, but it goes well past 100. You continue to take $77,000 out for the rest of your life. So if we did this to the traditional plan, our traditional qualified plan, we would have to take out $105,000 to after tax to create an after tax income of the 77,154. Okay, so this money would have to be taxed because it's not been taxed yet. So 105,000 taxed would turn into after tax distribution of $77,000. But if we continued this cycle here, we would simply run out of money in 11 years. 11 years. This plan continues to churn and churn. This shows this income arbitrage where we continue to churn out the 77,000 with no problems. It'll continue to run on the exact same growth pattern as this over here, but yet we would run out of money in the 11th year, okay? 11 years we'd run out of money. And this assumes in this time period we had no losses. So no losses, which I don't know if you can find a 401k plan or an IRA that can sustain no losses while being in the market, but it would still only last 11 years, okay? So you could see the power of how this plan works, how much more income you can distribute in a properly structured, cash maximized IUL plan. So with the opportunity of this much increased cash flow within a traditional retirement savings platform, to me, it was a no-brainer for me to utilize this strategy for the vast majority of my retirement. And I even set up my kids for their retirement strategy. And then my kids, it's amazing when you have young kids, the time for these things to grow and mature. It's amazing what you can produce with a rather small amount of money going into the plan. You can produce a sizable six-figure income stream for them in retirement. So I'm using this strategy as the main platform for my retirement cash flow. My policies are on target to produce multiple six-figure tax-free income streams for my retirement. And my kids, again, are set up with that same type of plan, and it'll create them the same thing in their retirement as well in many years to come. So again, the reason why the top 10% earners in America own over half this tax-free cash value asset, and the 22% is owned by the wealthiest 1%, well, this is a private plan between you and the insurance company. There is no regulations imposed by the government. You have complete control of your plan. Bottom line, this type of plan puts control in your hands, not the government's. There's no criteria that has to be met. There's no timelines. There's no penalties if you want access to your assets. There's none of that are normally in traditional qualified plans. So you can easily understand why the ultra wealthy are drawn to these types because of those benefits I just mentioned. The cash maximized IUL is truly sweeping across the country. As the years go on, people are understanding and starting to learn about these strategies. Now sales are over $2 billion. They've steadily been climbing. As this is gaining traction, you can see this huge increase, doing $2 billion a year in sales. For all of it did in 16 did 1.97, and of course 17 is over $2 billion. So as you can see, the trend has steadily grown year after year. It's simply a great way to create cash flow, and more individuals are getting involved. So the next question is, how would this look for your situation? All right. Everyone is a little bit different. It's not a fit for everybody, but how would this look for you? We spent a good amount of time today talking about this, and I've shared the strategy that can safeguard against your assets from market losses and taxation. And now it's up to you to take action. Okay. So you can either take the information I've given you and you can go out and implement it on your own. You can go, find a way to see if this is a fit for you, or you can start the conversation with our team here and we can put together a custom retirement you can count on blueprint just for you. And we'll educate you through this whole process. Completely educational process here. We'll put together a blueprint, see if this is a fit for what you're looking for, and see if it can complement what you're already doing. Okay? Again, not everybody's a fit for what we do. We completely understand that. But looking at a plan based on your situation will give us a good idea if this works for you or not. Okay? Now, in this blueprint, what you'll receive is an exact custom blueprint showing you how much tax-free income you could produce based on your situation, okay? A side-by-side comparison of other investment options. Let's look at it compared to some other options. and see if it works better than some other strategies out there. Okay, and then of course, once you have this information, you can then make an educated decision to see if this is what you're looking for. Because I want to make this as easy as possible for you. All right, I want you to get your custom plan. It has your unique situation. Okay, there's no charge or obligation at all. All right, no charge, nothing. I want this to be as easy as possible. I want to provide this to you as a completely pure value. Okay, again, this is an educational step to see if this is a fit for your situation. Now, I have to warn you, and it's very important to understand that not every individual who is dedicated to building these types of plans the right way. All right, they have to be built the right way. They have to be built correctly, or it could be detrimental to your savings if they're not built with reducing costs, fees, commissions, everything. These can be very, very done. I guess you could say done in a negative platform, and could reduce the actual performance of what's going to happen, what would be for you in retirement. All right. So my team has been building these plans the right way for over a decade and are ready to take you through the whole process. So if you want to learn more to see how much tax-free income you could have, simply just click the button below, schedule a time, 30-minute conversation. We'll talk to you and kind of understand what your situation is and start framing up a plan and building it for you. And then, of course, presenting it to you when you're ready. You can go click the button below. You can simply call us at 800-920-4304. That's retirementyoucancount.com. Again, the button below if you want to go ahead and schedule a 30-minute call. And remember, since you stayed on for the whole presentation, I will be sending you a free hard copy of the book, Tax-Free Retirement. You simply go to our website, retirementyoucancount.com. You go to the contact, type in free book offer, and we'll also obviously ask for your name. Send that in to me, and we will get the book mailed out to you as soon as possible. Okay? So again, retirementyoucancount.com. Go to the contact, type in free book offer, and we will get that book sent out to you ASAP. All right. So again, call us today, 800-920-4304, or simply just click on the link below, and we can start the process of getting some information from you to start building you a custom blueprint that will show you how much tax-free income that's not subject to market risk that you can depend on for retirement to either supplement what you're currently doing, or maybe it could be a lion's share of cash flow for your retirement planning. So again, give us a call or request the blueprint below, and we will hope to see you soon. Thanks so much. Have a great day. Bye-bye.